Hello and welcome to exciting workshops for your CMA September and October preparations. So these workshops are being conducted for your revisions, for your concept clearing, for your preparations, and you can see those for your future workings. Currently, which topic we're gonna focus? It's external financial reporting decisions. By the way, as a response of an audience, we have thought and we are working to make it a 2 day full workshop for your comprehensive training and understanding of the topic. Before moving forward to the list of the topics which we're going to teach you in this session, let us go to the brief introduction of your trainers. At first, let us look toward the first trainer introduction. So, I am Mr. Daniel, and I'll be training you along with my another partner trainer, Mr. Usman, as we both are highly finance qualified. First of all, if I introduce about myself, I'm a part qualified chartered accountant, I am a chartered certified accountant, a UK finalist, and as well as I'm CMA USA Part 2 candidate. I hold a professional certificate in affiliate financial and management advisor as well. I'm a certified financial modeler UK. I hold another financial modeling certification. It's called an advanced financial modeler. I hold a professional certificate in financial analysis and analyst from LinkedIn Learning, and I am a member of Institute of IFA UK as well as IPA Australia. Institute of Public Accounting Australia. I'm SAP Business One certified as well as working as a freelancer consultant. Currently, I also serve as a financial planning analysis manager in a UAE based firm working as a remotely. Let me introduce towards the Mr. Sman as well. So he is as a finance professional and he is chartered certified accountant UK as well with the specialization in advanced audit and assurance and advanced financial management. He earned a gold medal in MS Accounting Finance where he specialized in financial investment planning, derivatives, and portfolio management. His professional career includes a trainer at Pakistan Audit and Accounts Academy under the SIPFA UK training. By the way, if you don't know about the SIPFA, it's a chartered institute of public finance accounting or accountancy UK. So those made a special trainings for the audit professionals in Pakistan. And Mr. Usman was the one being part of a training team. And he specialized there in financial reporting, financial management, financial statement analysis as well. So he worked on a group accounting and impairment of assets. If we look towards his professional career moving forwardly, he's a trainer for ICW accounting paper, ICW financial accounting and reporting IFRS version paper, and he is an ACC tutor as well for financial accounting, financial management, financial reporting, and strategic business reporting as well. Currently, he is also serving as assistant manager in public organization and he is visiting faculty member of University of Lahore. So these two trainers are gonna launch your workings, gonna train you, gonna give you comprehensive understanding of your topic on external financial reporting decision. I hope you enjoy the session and you would be learning a lot from these two trainers. By the way, in the next week, we have scheduled the part 2 training as well on financial statement analysis. Don't miss that training as well. That will be more comprehensive and it will be very benefit for the part 2 candidates as well. If we look toward the list of the topics which we're going to teach you today, it starts from the financial statements, it starts from the financial statement interconnections, then we're going to look towards income statement, balance sheet, the cash flow statement, and we will be looking toward the IFRS and US GAAP differences side by side. So we both trainers will be training you side by side. At the first, I'm Daniel and I will be moving forward and will be start teaching you toward the financial statements. As you know, in IS1. So first of all, I'm gonna start with my financial reporting, or you can say the IFRS is that there is an accounting standard. It's called IS1, which helps for the presentation of financial statements. In presentation of financial statements, we study income statement, we study balance sheet, we study the cash flow statement, we study statement of changes in equity, and the last, the very important thing, we look toward the notes or schedules or workings of our financial statements. These five components are the financial statements, and they're combined to make a set of financial statements. This is already been defined in IS1. At the current stage, as 2024 gonna be end, they gonna the IASB board, International Accounting Standard Body or a board, they're gonna launch another standard. It's IFRS 18, which gonna show more better presentation of your financial statements. As you look toward the financial statements, these are very important. Your income statement, it explains about the performance during the year. But as you see its format, it compiles and it says that income statement starts for the year. So it is being prepared for a current year and it has no relevant decisions with the future workings. By the way, it is an input. By the way, it is an assumption, or you can say it's a base working for your future predictions. But you prepare in actual a current year financials, that current year income statement would be preparing for a one single year and that would be lasting for a single year. It wouldn't be have an impact on the future unless there is a change in policy. If we look toward the change in policies retrospectively or prospectively, IS 8, so it's an International Accounting Standard 8, side by side, the IFRS workings gonna be taught you, which gonna relocate you the US and IFRS gap differences as well. So according to IS 8, we set off or we make a changes in our policy, and that policy accordingly we prepare the financial statement again. We prepare the revised financial statements here. Sometimes we prepare the interim financial statements, and that can also be revised as well. This was being introduction toward an income statement. We start from a revenue and it ends towards my net income or a net profit. So this was an income statement. There's another thing that is called statement of comprehensive income. We're gonna look that as well. So statement of comprehensive income includes some unrealized things as well. It includes your revaluation gains. It includes some revaluation losses as well. You say revaluation surpluses. It's being a part of your IS 16. So again, your accounting standard comes forwardly. You got to see some other things as well. There is a proper list of comprehensive income items that will be shared to you as well. As being the partner of Hook International, we will be using the Hook books to teach you side by side, and we're gonna explain you through my slides as well. All of this material will be shared to you instead of the Hook material, but we will be try our best to ensure you the best knowledge. We were talking about the income statement. Income statement shows the performance. It starts from a revenue and at the net incomes. How does my net income or a net profit or profit after taxes gonna relate my balance sheet, gonna relate my cash flow statements? That is being taught as the financial statements interconnections. My cash flows are being presented separately as an accounting standard IS 7. So there's an accounting standard IS 7 that explains you the cash flow statement. That cash flow statement gonna prepare, and it's a very important thing. It's been a component of your balance sheet as a current asset. So now cash flow statement is very important to prepare to complete your balance sheet. Remember one thing, cash flow statement is also prepared for a single year. You prepare your income statement or your comprehensive income for 1 year. You prepare your balance sheet or statement of financial position, which shows your current position, where your company stands, where your organization stands. It includes your historical information, it includes your past information, and your current information. That's why it is being represented as on or at on. It represents the current position where my company stands. And the third thing, your cash flow statement. It is also being prepared for the year. It will be looking toward the current year adjustments into the cash movement and getting you the cash closing balance. Your financial statements are being connected side by side, and their connections is very important for your understanding. If I look toward the connections between my financial statements, that you can see very deeply. Let me move towards my next slide. Here, you're going to see towards your relationship between the three statement models. So, why I explain you the three statements? We earlier discussed that there are five statements: statement of balance sheet, of financial position, statement of comprehensive income. So, now onwards, I'm going to use my income statement or statement of comprehensive income to show the performance. Third thing, statement of cash flow. So these three statements are very important. The fourth thing, the statement of changes in equity, which shows my equity relations with my important thing, with my surpluses, with my retained earnings. That gonna be stated as a workings if we go toward my financial model. But yet we're gonna understand the relationship between the financial statements. The fifth thing, the notes, the workings. As you see in the top, As you see in the top, there are the three statements, it being relating towards your financial model, which comprises your income statement, then it comprises your balance sheet, third, it comprises my cash flow statement, and these are very important for my business valuations, for my financial analysis, for the corporate restructuring, and for further things, for the financial decision making, as well as many of the things can be moving forwardly. If we look towards the connections between my financial statements, it provides a comprehensive overview of my company's financial model and company's health. If you look toward the right, there has been a snapshot of your income statement, cash flows, and the balance sheet, but yet that's not a correct. We're going to look toward the deeply into the right model available in Excel for you. In just a minute, I'll be sharing you that model which explains all of your relationships and interconnections. First of all, if we look deeply, there is a first connection that income statement and my balance sheet relations. My income statement, net income, as it's a bottom line of an income statement, it feeds toward my balance sheet equity portion. It has been mentioned here as well. My equity portion, control B, retained earnings. So my retained earning include my net incomes, my dividend payments as well, which affects my balance sheet. As my income statement changes or a comprehensive income changes, my balance sheet also changes. This helps for the scenario analysis. This helps for the sensitivity analysis. This connection shows my company's earning overall effective on and financial position. Yes, as I told you earlier, your balance sheet locates your position, and that has been related very much. If you look toward the second point, your depreciation and amortization. Yes, first of all, you depreciate or amortize your intangible assets or your property, plant, equipment, long-term assets. These are being the part of your income statement, and then they are being adjusted with your assets, with your intangible assets, or your balance sheet to locate your market values or a book values with the balance sheet. Remember, your balance sheet includes the book values. It includes sometimes the fair values. The fair values are being measured separately. There's been an accounting standard on fair values as well. That is IFRS 13. That's another thing we're not going to discuss those. We're going to working on US GAAP. As depreciation and amortization, it has been explained that these are some non-cash expenses. So we're going to start with my income statement. If I move towards my ending point near my operating expenses, then I got my subtotal. That subtotal is called my profit before interest, tax, depreciation, and amortization, the five elements. But if I move deeply, it is also called EBITDA, earnings before interest, tax, depreciation, amortization. After EBITDA, I depreciate, I deduct, I make a subtraction of my depreciation amortization to get my EBIT, earning before interest and tax. So these are the non-cash items. These relates to my cash flow statement as well. If I look towards my physical impairments, here we have a financial model which comprises the three statements, and I'm gonna show how it relates. You got your income statement. Here, my income statement starts from a revenue, then it moves towards my cost. It moves towards my some other adjustments, my expenses, and then I got my EBITDA. EBITDA, or you can say it can be used slash, let me use profit before interest, tax, depreciation, and amortization. So it's up to you how you relate those. Then you subtract your depreciation and amortization. I can type for you and show you the similar things. Depreciation amortization has been deducted to get your EBIT. You got your interest of finance cost. You got EBT or profit before tax. Your taxes are being converted into deferred tax, current tax, that is IS 12 workings. You got total income taxes and then the net incomes. This was a introduction. This was a format of your income statement. By the way, after your income statement or net earnings, you wrote another thing that calls your other comprehensive income. And under the under comprehensive income, you look towards your revaluation surpluses. You look towards the further measures of your other comprehensive income, and then you get towards other items of your comprehensive income. At the end, you got your total. Here at the end, if you see towards total comprehensive, you look toward the total comprehensive income, how does it relate, and you see the things simultaneously. If I use the sum function, it adds on my net incomes, comma, then all my items of comprehensive incomes that have been related, and then these items are being the part of my workings. Currently it is being showing same as my net income because there was no revaluation surplus yet. If I go towards and make some formatting for you, because formatting is very important for the decision making, for telling you different things. Let me go and bold this. Just wait Alt H I R to insert a rows. Though you got a training as well on how to move or on how to work for your revaluations and on an income Excel workings. Now you see you got a total comprehensive income. Your net income is being the part of your retained earnings. If I go deeply towards my this cash flow statement would be taught you literally. Here I got my balance sheet. By the way, this was a manufacturing company and whose financial I projected. Just for explaining you how the financials being linked. Here you got under the equity portion, you got your retained earnings. See your retained earnings, it links towards myself. Again, references, interconnections. This interconnection is very important for your decision making. It says K345 cell. Currently, we are in K188. Let me press F2 key and move down where my retained earnings schedule or working being prepared to show you the relationships. My working capital schedule, debts and interest workings, and here is being an equity part. Now you see this is being highlighted, retained earning closing balance. As my balance sheet includes the closing balances, the book values closingly, so that's why my closing value has been selected. Now you see retained earnings schedule. It says starting from an opening balance, then it look towards the net income. If I press towards net income, it says it is being linked towards my cell K104. Where is my 104? We are at the bottom. Let me look towards my 104 cell. We are under the cash flow statement, and now you see your income statement, and it's being linked here to $29.7 million. Your net income is being related. This is how your interconnections and how your financial statements are being linked. This is very important for your decision making, for your future projections. As you are already being taught on a projected model, it's your lucky to see this thing. Equity portion. Let us look towards this next point. My balance sheet and cash flow relations, my working capital, very importantly, the first point that it includes the variations in my current assets, my inventory, my account receivables, all being the part of my working capital. Just wait for a second. My working capital include my current assets, current liabilities. My current assets are being the part of an inventory and account receivables. And if I move forwardly, looking towards my current liabilities, it includes my account payables. These are being the part of my balance sheet and which have a greater impact in my cash flow statement. As I mentioned here, it's being the part of my cash flows from operating activities. Now you see differences, your interrelationships. Let us look towards my practical workings. Here I got my working capital schedule. Very important for you. My working capital includes my days for the year. Yes, this A 2019, 2020, 21. A means actual results. Then I got my projected or forecasted. I got my days in a year. Then I mentioned my income statement items because my working capital to be projected to be futurely to find it. I got to see my net incomes. You can see the net revenues. Then I got to see my cost of goods sold that has been mentioned here. Then my days of receivables, payables, all of these are being mentioned. It's being the company policies, then account balances. For the account balances, we develop a formula workings that how my formula relates. This would be explained again in part 2 workshop as a FSA, financial statement analysis. That would also be a comprehensive workshop for you. You got your net working capital, which closes your all account balances. You subtract your liabilities, you add your current assets, and get a net working capital. Here you got a changes in working capital, your previous working capital and your current working capital difference being the part of your cash flow statement. This was a working capital schedule. If I look towards my cash flow statement, this is a balance sheet, and here I got my cash flow statement. I got changes in working capital, which is being linked at a below towards my working capital schedule. By the way, my working capital schedule is already being linked towards my balance sheet. This changes in working capital, it's being a part of my operating cash flows. Remember that. Then you got your balance sheet, and here under the balance sheet, I already highlighted for you to understand. You got your account receivable balances, you got your inventory balances, your prepaid expenses, as a prepaid expense is also a current asset. That should be the part of your working capital. You would have a question, why prepaid expenses? Because prepaid expenses are being the percentage of your revenues. Your liabilities, currently you have only account payables, that way it has been referred here. Again, I'll show you the working capital schedule. Here you see your prepaid expenses, it has been made, it has been developed. Then how you forecast your future prepaid expenses, if you relate towards your forecast value, F2, it relates to the cost of sales. Sometimes As a company policies, you can make your expenses forecast on your revenues as well. Your other assets, it's being a part of your costing as well. I hope you are learning side by side with me your current liabilities, other liabilities, other assets. Third thing to look and to understand my income statement are to the cash flow relationships, how my income statement and cash flow relates. My operating cash flow, it includes my income statement items such as my depreciations and amortization, the non-cash items, my impairment losses, these are also non-cash items, my some unrealized gains and losses, these are being the part of my operating cash flows. We look toward the changes in working capital that relates to my balance sheet part to get my cash flow from operating activities. If I look towards my dividend and interest payments, these being the part of my cash flow from financing activities, which affects my income statement, looks morely. As my balance sheet and cash flow portion was being discussed, we missed 2 points, but that were very importantly. We look toward the long-term asset sales or purchases that is being the part of my cash flow from investing activities. We have a separate workings for a cash flow. In our workshop, we're gonna discuss cash flow in a details. That's why I'm not gonna teach you in a detail here. We're gonna look furtherly moving. And we have another trainer for your workings. My income statement to the cash flow relationships already been explained to you. You adjust your non-cash items, your interest and dividends, some other payments of equity repayment, of a buyback shares, debt repayment, borrowings of debt. These are being the part of your cash flow from financing activities. There's been an ending point that your closing cash balance, it's being a part of your opening balance or your current balance in a balance sheet. If you look towards your practical workings, let me go up towards my balance sheet. See here in my balance sheet, my current assets include my cash. It relates to the cell K149. That means it has been working downly or upwardly where I gonna relate it. If I move up, let us see. Here I got my cash flow statement, which relates my ending cash balance. That's a part of my balance sheet. I hope you understand the relationships. Next, account balance or account receivable. This has already been explained to you. Your net cash and cash equivalents, your cash flow movement, which include operating cash flows, your investing cash flows, your financing cash flows, and then you're gonna relate towards your cash and cash equivalents. If you look towards your opening balance or a beginning cash, your last year closing balance is being the part of your current year opening balance as it has been referred in. Your interconnected dynamics has been explained that your earnings and cash generations are very important. You earn for your incomes, and that incomes have an ability to convert your balances into the cash. That cash has been related, that a cash have been shown towards your cash flow statements. If you look towards your financial positions and the operations, it provides your companies at a point location, a companies at a point position, companies at a point health, that shows its period over period change as well. your financing, your investing, your other operations are very important for the investment decisions, are very important for the future decisions, for the management decisions, for the current purchasing or selling decisions, for the profitability analysis, for other analysis, for capabilities analysis, for the you can say the performance appraisal, performance measurements. That is very importantly these three statements. I hope you have learned very much in a deeply your relationships of a financial statements and a financial model that have interconnectedly related towards your working. If I look towards your textbook, here you got your textbook. I hope you are gonna look that as well. At a first, these are some uses of financial statements. We're gonna look that as well. Here, you got to see the very first topic. It explains you the financial statements are interrelated. Now relates to your previous learning that I taught you that your retained earnings are being the part of your balance sheet. Retained earning includes your net incomes. Net income is being the part of your income statement. Next, your balances of account are very much used to calculate your cash flow relations and your income statement relations as well. Then your cash changes also relate from your cash flow workings and then some other workings if you see towards the balances. It's just a theory, let us read it. It says financial statements articulate with each other. Yes, these are being related to each other, meaning these are interrelated. Let me highlight it. Yes, financial statements are interrelated. The different financial statements reflect different aspects of the same transactions or events and the circumstances. Yes, each financial statement shows different circumstances and it relates. That's why that has been mentioned double entry or single effect, no effect on a financials, while a double effect have a greater impact on a financials. If I look towards my amount of change in the retained earnings being the part of my balance sheet, then you relate towards your current year period movement or your previous year period movement. It equals to the net income on the income statement. Yes, I already showed you that your net income is being the bottom part that relates towards your retained earnings portion. Then you minus or subtract your dividends, your declared dividends. Your balance sheet, it includes many things which are being helpful for your income statement. I showed you your balance sheet if you got account receivable balance, if you got inventory balance, and if you got account payable balance, then you can forecast, you can calculate your working capital amounts, your income statement items such as revenue, such as cost of goods sold. This being a formula developed for the working capitals. The changes in a cash movement on a balance sheet, it counts from the beginning of a period to the end of the period, which relates towards my statement of a cash flows. Your current year increase and decrease that relates towards your cash flows. No one financial statement provide all financial information. That's why they have discovered, they have prepared different financial statements. Your cash movement relates towards your cash flow statement. Your incomes relates your income statement, which shows your revenues and expenses. Your assets, your liabilities are being the part of your financials, and that is called balance sheet. It says that these are very useful for making an assessment or a decision. A resource providers needs a variety of information. It includes information about assets, liabilities, equity at the end of a period. This relates towards your balance sheet. Then you got your comprehensive income during the year, which includes your revenues, your expenses, your gain or losses. Your cash flow period shows your cash movements, your investments, and some other distributions, share distribution, buyback of a shares. A full set of financial statements is intended to present that information. Here you got to see the elements of financial statements. So elements of a financial statements are very important, and these are easy to understand that your financial statements include components, as I told earlier: balance sheet, income statement, cash flow, changes in equity, your notes or workings. Your elements are very important. Elements of a financial statement include your assets, your liabilities, your equity portions, your comprehensive incomes, its components, your net income, its components, your revenues, expenses, or gain or losses. It explains about the general purpose financial reporting. General purpose financial reporting include a full set of financial statements plus the notes of financial statements and require supplement information. The notes amplify the complement information about the items in a financial statements. Yes, your general purpose financial reporting includes complete set of financial statements. Then it includes your furtherly workings, include your notes, some schedules. I showed you the schedules. Here at the top, you got your working capital schedule. Then your income tax schedule, your depreciation schedule. By the way, this is a waterfall schedule. Now, if I go back toward down and let us see what are the schedule. You got your debt and interest workings. You got your equity. You got your retained earning working. Where is my revenue and cost? Let me move up towards my revenue and cost. Here you got to see revenue workings, then your cost workings. See, all of these things relate towards each other. The notes are very important for the decision making. Notes are very important for your future predictions. Notes are very important to see if there is any change in effect, cost of production as well for the sensitivity analysis, for the scenario analysis. Financial statements used by businesses under the US GAAP, that explains you following. You got your balance sheet, you got your statement of comprehensive income or the income statement, you got to see statement of changes in equity, then you got to see statement of cash flows. The very fourth and the fifth part, if you relate toward it, that is called, let's just me use, I hope I can find a note to add a note. You got to see your notes developing. I can add a note here side by side. Let me add. Then you got to see your notes to financial statements, asked to complete a set of financial statements. These are the five components for the, you can say, IFRS IS1 workings. As you see, your US GAAP also implies that there are the four major statements. If I click towards and it explains notes to financial statements, let me close my text workings. Just me related. I hope you are learning side by side, understanding with me. Just wait for a second. Let's have a water break. Heading towards my other partner as a trainer, so he will be training you for the balance sheet and the cash flows, and then laterly I'll come back and will train you furtherly. I hope you like the session. Goodbye from me yet. Thanks a lot.
Liquidity is basically the capacity of the company to meet its short term obligations. This is liquidity. And what is solvency? The capacity of the company to meet its long-term objectives. Okay, so if we are going to meet our if we are going to meet the requirements of our non-current liabilities, if we have that capacity, the company is solvent. Okay, and if we have the capacity to meet our short-term obligations, or you can say we have enough current assets to meet our current liabilities, so it means the company is quite liquid. Okay, so the statement of financial position basically tells about these two things. Either the company has a good liquidity position, and either the company is solvent or not. Does the company have enough non-current assets, or does the company has enough non-current assets to meet its non-current liabilities? Does it have the capacity, the future resources, the future cash flows which are required to meet its non-current liabilities? The balance sheet also basically tells how much of the non-current assets are being financed through your through your uh, loan contracts, through your lease liabilities, meaning how much of the assets of the company are being financed through debt and how much of the assets of the company are being financed through the owner's equity. Okay, so the statement of financial position is very helpful in evaluating whether the company is liquid and whether its company is solvent. So it helps users to assess the company's liquidity, financial flexibility, net resources available, and its capacity for generating net future cash flows, exposure to risks, and its ability to meet its long-term financial obligations. Liquidity refers to the time expected to elapse until an asset is converted into cash or need to liability to be repaid. The financial flexibility is the ability of the business to take effective actions to alter the amounts and the timing of its cash flows to enable the business to respond to unexpected needs and take advantage of the opportunities. Okay, so if we have a lot of debt, a lot of fixed liabilities, so there would be less flexibility for the company. Okay, and if the company is quite debt free or the financial leverage of the company is low, then we would consider the company is quite flexible, meaning if the company has high non-current asset base, then the company will be in a position to take on more debt and would be more flexible and would be on a more advantageous position to negotiate better deals with the debt holders. Solvency refers to the company's ability to pay its long-term obligations when they are due. A company with high level of long-term debt relative to its assets has a lower solvency than the company with a lower level of long-term debt. Risk refers to the unpredictability of future events, transactions, and circumstances that can affect the company's cash flows and the financial results. The statement of financial position can also be used in the financial statement analysis to assess the company's ability to distribute cash to its investors and provide them with adequate rate of return. Information provided in the balance sheet about the company's assets, liability, and equity does not indicate the value of the business. However, along with other financial information, it provides an insight that may enable the resource providers to make their own estimate. Meaning, majority of the ratios are calculated using the information given in the statement of financial position. Balance sheet accounts are permanent accounts. Balance sheet accounts are not closed at the end of the accounting period, unlike the income statement. Elements of the balance sheet, we have already discussed this. They are normally the assets, the liabilities, the equity, or investments by the owners and distribution to the owners. When we discuss about distribution to the owners, that is basically our dividends. Dividends are basically the amounts which are distributed to the owners. Classification of the assets and liabilities, either the asset is classified as a current asset or either it is classified as a non-current asset. If it is a non-current asset, it can be an IS 16 property, plant, equipment. it can be an investment, it can be a developmental expenditure, it can be a goodwill, it can be an intangible asset, it can be a long-term investment. It can be a investment in the debt instrument of another company. Okay, so these are all of your non-current assets. It can be a investment in a it can be an investment in associate. Okay, it can be an investment in a joint arrangement or a joint venture. So the current assets normally include assets which are used for the operating cycle of that company. Okay, that includes the cash, that includes the inventories, that includes the receivables, that includes the stock. All of these are basically the current assets. Okay, the current assets are cash and other assets or resources that are expected to be realized in cash or sold to consume during the normal operating cycle. This includes cash, cash equivalents, means short term, that can be the bank, demand drafts, marketable securities, receivables, assets classified as current assets. Under IFASB Revenue Recognition Standard ASC 606, contract assets represent the company's right to a consideration for goods and services the company has transferred to a customer when the right depends on something other than the passage of time. For example, company's future performance before the company can invoice the customer. Contract assets may be current assets or non-current assets or both. If we are creating a particular asset for our customer, the amount which we have invested in that particular asset, that is basically a contract asset. That can be a warehouse, that can be a railroad, that can be a bridge which we are constructing for that particular customer. Short-term notes, receivables, inventories, prepaid expenses, these are not normally repaid, but you would get the future economic benefit, you would get the future benefit from these prepaid expenses. Funds that are restricted for the current purposes, if cash and cash equivalents are being held for a current purpose, such as payment of the current obligation due within a year on operating cycle, whichever is longer, or a compensating balance to support a short-term borrowing. The cash should be reported as on a separate line. What is a separate line? Means it should be separately presented on the face of the statement of financial. Non-current assets, that includes our property, plant, equipment, that includes our developmental costs, that includes our investments, that includes our investment in associates, that includes investment in development costs, that includes our intangible assets, that includes our goodwill, that includes our right to use assets. Right to use assets are those assets which are recognized as per the IFRS 16 lease agreement. Okay, net deferred tax assets, the cash surrender value of a life insurance policies on the key lives of the employees. So afterwards, we will start one by one by defining all of these assets. So what is a property, plant, equipment? Can anyone tell me what is a property, plant, equipment?
Sir, all the property, plant, and equipment means the place where production is going on and all those things. Property where the factory is set up by the owner.
Okay. Uh, One thing I would like to ask all of you, are you guys planning to go for the CMA examination, or are you just still considering that you will be taking the classes and then go for the exam? This is a very small question that I would like all of you to answer.
Sir, I have booked my exams on 23rd October, part 1.
You have already booked your exam, right?
Yes, sir.
Mohammed Saad, are you also going to take the examination? Mishal Said,
Sir, I'm considering right now. I still did not book my exam. I'm looking for the classes. I will take the classes, then I'll book my exam in coming intake,
okay.
in coming
Hafiz
Monday.
Hasib, okay, okay. Hafiz Hasib, what are you considering at the moment? Daniel Ali.
Yes, sir, in the January 2025.
Okay. And Mr. Matthew. Okay, Mr. Matthew does not want to answer, right? So let's get back to the workshop. So what is the property, plant, equipment? These are all the tangible assets which are used in operations, that are used to generate future cash flows, that are used for the production of goods, supply of services, administrative purposes, or rental to others. They are normally, as per IFRS, as per IS 16, they are normally recognized at your carrying values. Certain amount of depreciation is deducted from them, or they can, the revaluation model can to measure them. Okay, if the revaluation model is used, you can measure them at fair value, right? So here it says that property, plant, equipment are tangible assets used in operations that will continue to be used beyond the current period. Normally, they have an accounting life more than one accounting period. It's another part of the definition that those assets which are used more than one accounting period, they are known as property, plant, equipment, or they are known as non-current assets. Okay, these are fixed assets purchased. They are recorded at their cost, including shipping, installation cost. There are certain costs which are included. Those are known as directly attributable costs. The cost is then expensed over the life of that asset through depreciation, amortization, and depreciation. Examples of property, plant, equipment include land, building, machinery, future equipment, and vehicles that are owned. Natural resources such as gas, minerals, and timberland that are owned. Natural resources other than land are depleted. Property, plant, equipment other than land are depreciated. Land is normally not depreciated. Okay, it is either tested for impairment and nothing else. Land is not depreciated or depleted because it is not used and does not wear up. Intangible non-current assets, for these assets, IS 38 is normally used to recognize these assets. Intangible assets includes your developmental cost, it includes your patents, it includes your franchise rights, it includes your licenses. Okay, the normal definition of intangible asset is basically it is an identifiable non-monetary asset without its physical substance. Okay, it is an identifiable non-monetary asset without its physical substance. So the asset needs to be identifiable. For the purpose it needs to be identifiable, it should be separable, or it should arise from legal rights. It should be non-monetary, meaning not in terms of cash and cash equivalents. It should not be in terms of your cash. It should be an asset. To be an asset, it should be a resource which is controllable, from which of inflow of future economic benefit is probable, and cost is reliably measured. And it should be without physical substance, that it cannot be touched. Okay, so this is not the normal definition of a non-current intangible asset, okay, as per IS 38. So intangible assets do not have physical substance, but they provide the benefit to the company. So this is the two key components of the definition. Inflow of future economic benefit is probable and it does not have a physical source. Intangible assets may be either purchased or developed internally, means developmental cost, or purchased. You can either purchase a license, you can either purchase a customer list, you can either purchase a patent, you can either purchase a distribution right, export license. Okay. However, because an asset is recorded on the balance sheet, comes about only by means of a prior transaction. Internally generated intangible assets are not recorded on the balance. This is as per the US GAAP. In the as per IFRS, International Financial Reporting Standards, you can record internally generated developmental costs in the statement of financial position if you meet a particular criteria. Okay, but internally generated goodwill is not allowed to be recorded. Okay, brands are not allowed to be recorded. If you are incurring a marketing expense or a specific customer list, that is internally generated brands and goodwill cannot be recognized as an intangible asset because the definition of an intangible asset does not allow this. Okay, if the training cost is being incurred on employees, that cannot be recognized as an intangible asset because human beings are not controllable. Okay, so the definition of the asset does not allow the training cost to be capitalized. Examples of intangible assets includes your copyrights, patents, goodwill, only externally generated goodwill, which comes in the form when a subsidiary is being acquired. Okay, only then a goodwill can be recognized, and that goodwill comes under the definition of IFRS 13. Trademarks, franchises, leasehold improvements, which are improvements made on leased property at the lessee's expense and that cannot be removed by the lessee when the lease period is over, are also intangible assets as the right of use of the asset obtained under the lease agreement. The cost of an intangible asset with the limited life must be amortized. It should be amortized, but just like a depreciation, it should be expensed to a particular period. An intangible asset with an indefinite life, such as goodwill, is assessed periodically for impairment. Current liabilities, again, these are the liabilities part of the operating cycle. They include accounts payable, cash dividends payable, any contract liabilities, other deposits received from customers, such as advance payments received on particular contract, agency collections. What is an agency collection? Agency collection is the amount which we have collected on the behalf of some other third party, which needs to be paid to that party. Okay, so that amount is basically our liability. It cannot be included as a part of our revenue. Obligations due on demand, short-term obligations, current portion of long-term debt, and lease liabilities. That part of the lease liability which is going to be paid in the next year, that is also a current liability. Taxes payable, wages payable, other accruers, long-term obligations callable at the balance sheet date, assurance type warranties for which the warranty extends only in the next account. Current liabilities do not include debt to be paid or funds to be accounted for. Classified debts non-current means lease liabilities and long-term debts are not a part of it. The portion of short-term obligation intended to be refinanced by long-term obligations. Bank overdrafts, an item that could be reported by netting against the current asset cash or by adding it to the current liability as needed. Okay. Again, here is another examples of your non-current liabilities. We have already discussed these long-term notes, bonds. This is as per IFRS 9. Contract liabilities classified as non-current. The long-term portion of long-term debt and lease liabilities means IFRS 16 and IFRS 9. Pension obligations as per IS 19. Net deferred tax liabilities as per IFRS 12. And the non-current portion of insurance type warranties for which this is as per IS 37. What is an equity? We have already discussed equity. Equity is basically it evidences the residual interest of the shareholders in the assets of the company after deducting all of its liabilities. What are the components of equity? That is the capital stock or the par value, additional paid in capital, excess amount, also known as the share premium, the retained earnings, also known as the accumulated profits, which we have already discussed, and any other comprehensive incomes and reserves. Non-controlling interest. If we are creating or preparing our consolidated financial statements, another element which is part it is which is included as a part of your statement of financial position or as a part of your equity is the non-controlling interest. A portion of equity of subsidiaries partially but not wholly owned, meaning it is included in those consolidated financial statements where the company has where the parent company has a controlling interest but does not include the whole company, but means does not own the whole company, does not have 100% ownership on that company. It has a controlling interest, particularly more than 50%. Okay, so the remaining 40%, 30%, or the 45% that is represented as a part of the non-controlling. The treasury stock. The treasury stock is basically those shares, a contra equity account that represents that have been repurchased by the corporation. If you purchase your own ordinary shares out of the market, that is known as a treasury. Okay. Benefits of the balance sheet and limitations of the balance sheet. There are certain limitations uh, which you guys can read from here. What is an income statement? We have already discussed this thing. This is an comprehensive income and income statement. It defines the same things which we have already discussed here in our one note that I have already discussed. That if we start with the revenue, deduct cost of sales, gross profit, operating expenses, operating profits, interest, profit before tax, tax, and then net profit. So at till this point, this is the statement of profit and loss or the income statement. If we include another area that is the other comprehensive income, that is revaluation surplus, gains, remeasurement component, investment gains, and translation reserves. All of these, if these elements are included, that creates another comprehensive. Uh, I would like to show you some things. Can you just excuse me for a minute? I would need to stop sharing my screen for a minute only. Okay, so uh, this is one of the financial statements of a Pakistan Synthetic Limited company. So this is what we are going to discuss. I'm just trying to show you the how the financial statements are being presented, how the financial statements are presented, and how these assets are written. So here you guys can see that there are assets. We start with our statement of financial position. There are assets, non-current assets. This is the property, plant, equipment. Then there is a right of use assets. Okay, right of use assets are those assets which are accounted for as per long-term loans to employees, because this is the amount which is paid to the employee, and this is a long-term loan. So we have to get these amounts back. Long-term deposits and investment resources. Then there are current assets. These are stores and spares, stock and trade, trade debts, loans and advances, short-term deposits and prepayments. Okay, short-term investments, other receivables, and cash and bank balance. Another thing you guys should remember that the statement of financial position is normally prepared on a comparative basis. Okay, according to as per previous year and in the current year. So we will be able to compare the previous year balances with the current year balance. Then there are total assets, equity and liabilities, share capital. This is the authorized capital, issued and paid up capital. Okay, this amount is not included in the total because this is the total amount of capital which has been authorized. Okay, this is the amount which has been issued. Then there are non-current liabilities, long-term borrowings, liabilities, deferred tax, staff retirements, deferred income, government grants, and then there's deferred taxation. As IS 20 government grants have current liabilities, trade and other payables, short-term borrowings, a two markup, current proportion of long-term borrowings. We have already discussed this. Okay, current proportion of these liabilities and current proportion of deferred government grants. Then there's tax net. Net means we have any tax expense or if there was any deferred tax, we have already net this amount. And any unclaimed dividend which has not claimed by the investor or the shareholder. Any contingent liabilities which needs to be disclosed is written in the notes to the accounts in note number 27. These notes represents the explanation of a particular line of item which will be given the accounting policy, the accounting estimate, the respective commentary of this particular line and its comparative working for the previous year and the current year. It is given in the note number 5. Okay. Then we come towards our Pakistan Synthetic Limited Company revenue. Revenue, that is statement of profit and loss. Revenue, cost of sales, gross profit, administrative, general expenses, other operating expenses. This is basically the operating profit. Then there is other income, any finance cost. Here, Nilesh, you can see this is the finance cost. Okay, and this finance cost, this breakup can be checked to point number 34. So let's go towards point number 34. We will be able to discuss that. Here, this is the other comprehensive income. Okay, this company follows two statement format. Okay, it separates the other comprehensive income from the statement of profit and loss. So the other comprehensive income. Let's go towards your point number 34 and see the breakup of that finance cost. So you can see the finance cost is made up of your Islamic markup, long-term finance, short-term istisna, short-term running musharka, SPP finance scheme, and there's conventional markup, short-term running finance, investment, interest on worker participation fund, interest expense on lease liability, and interest expense of GIDC and bank charge. So all of those expenses which are related to the financing activity are basically included in the finance. Okay, so all of the working and the comparative working and the related commentary estimates, all of these things are given in the notes, right? And finally, I would like to discuss the statement of cash flow. Does anyone know what is basically statement of cash flows? Nilesh, would you like to discuss what is statement of cash flows?
inflow and outflow of cash.
Other than that,
Any transaction which is done by the cash, it recorded in cash flow statement.
but any transaction which is done in cash is also recorded in the statement of profit and loss. Statement of profit and loss includes all the transactions which are done in cash basis and in non-cash. Okay. Statement of profit and loss also includes transactions such as our estimates and our judgments, such as our provisions, such as our depreciation, such as impairment losses, such as amortizations. Okay, that also includes. So you can say the statement of cash flows, one of the most important aspects of statement of cash flows is the classification of cash. We classify our cash, and how the cash is classified. We
So,
classify it in
uh, according to our IS 7 or IFRS, there are the three different classification of cash.
yes. One is the cash flow from operating activities, cash flow from financing activities, give me a second, guys. I think so. There is some problem. Financing activities. So there are three classifications. Okay, cash flow from operating activities. What are the operating activities? All those activities which are being undertaken from earning the revenue. Okay, we earn our revenue through our operating. So all that cash is generated from doing the business. That is known as cash flow from operating. Then there is cash flow from financing activities, and then there is cash flow from investing activities. Cash flow from investing activities is what is the amount of cash that we have invested in doing internal and external investments. Internal investments are being done on your own non-current assets. You acquire your new non-current assets. You expand your new non-current assets. You you provide your developmental cost. Okay, you can go for joint ventures. You can go for associates. You can acquire other companies' financial assets. These are all of your internal and external investments. Okay, if you are going for joint ventures, if you are going for acquiring other companies' equity instruments, if you're going for other companies' debt instruments, these are your external investments. You can acquire other companies. Uh, you can even acquire other companies. Okay, you can acquire a subsidiary. So that is basically an external investment. Okay, again, for that investment, for to do that investment, you would need a certain amount of cash. That certain amount of cash would either come from your operating activities, or it would either be compensated through your financing activities. Do your investment, do your internal and external investment. You will need to finance the investing activities. To finance these investing activities, the financing activities, the classification or the cash flow from financing activities comes under your heading. Now, what does the financing activities tell you? It tells you how much amount of money did you take, or did you acquire from, or did you get from issuing new equity, from issuing new loan notes, or how much of your assets are being financed to your leases, how much dividend was being paid to your equity shareholders. So these are basically. financing. So one of the most primary benefits of preparing a statement of cash flow that we get to classify our cash. We get to classify our cash flow into three headings. So we will be able to take decisions, or we will be able to forecast our future cash flows based upon these classifications. So one is from operating activities, other is from financing activities, and then there is from investing activities. Okay, let's go for a particular example in as per Pakistan synthetic limited is concerned. Here you can see these are the cash flow from your operating activities. The cash generated from operations, the reconciliation from profits to cash is given in note 41. So this is the net cash generated from operating activities. Then there's cash flow from investing activities. Capital expenditure includes the expenditure which is done on your non-current assets, uh, the investment in associates that was made, profits from saving accounts, and the net cash used in investing activities. The normal answer of the cash flow from investing activities is a negative. Then there is financing activities. How much cash was generated from financing purposes? Payment of lease liabilities. There was a net amount that was paid. Payment of long-term borrowings. Proceeds from long-term borrowings. This is the new finance which you have arranged. Short-term mudarba, which has been arranged. Dividend which has been. So this is the net cash generated from financing. Now this is a very normal cash flow of a company. The normal cash flow of the company normally has the operating activities answer is normally positive, the investing activities answer is normally negative, and the financing activities answer is a positive. Why? Because the business is producing cash, the activities are generating cash, the investments are being made, and for those investments, the financing activities are generating cash. Okay, so this is basically the cycle which runs, and this represents a normal cycle. There can also be a situation where the cash flow from operating activities can be a negative. This would create your going concern problems, as the business is not generating cash, as the business is not generating new capital, but the business is consuming the capital. Okay, the investing activities, if it has a positive answer, it means you are selling your non-current to meet your operating needs. And if the cash flow from financing activities has a negative answer, that means that financing activities are not generating cash, but they are also consuming cash. It means you have not adjusted your timing of cash flows, and the debt repayments are due. So you are repaying huge amounts, and you don't have enough money to finance your investing activity. So this would be enough for today. And if you guys have any question, so please be open. You can answer first one, ask any question. And if you have any suggestion regarding the tomorrow's workshop, you can also give me that. I would try to follow that as well. Yes, any question? Nilesh, Saad, Mishal, anyone?
Sir, basically, I don't have a question. I just want to know about the, your institute or whatever you have, because I just got the link from one of my friend that he told me that there is one workshop for CMA Part 1. And if I want to join the classes or something like this, to whom should I contact?
Okay, I think so. You should just give your name in the group, and all the particulars will be handled by Mr. Daniel, and he will provide you with all of the requirements, the fee structure, and each and every. Okay.
Sure, sure.
Okay. Anyone, if anyone has any question,
I want to know tomorrow what time will be the class.
The same time at 8 o'clock Pakistan Standard Time.
Okay.
Yes, Nilesh, do you have any question? Nilesh, I didn't hear you. I think there's some kind of a problem. Okay, we'll see you tomorrow at 8 o'clock. So, you guys tomorrow, inshallah. Thank you so much.
Thank you so
The
much, sir, for your time.
recording will be shared, and the file will also be shared, and any particulars.
Thank you very much, Mr. Usman, as you took the session very greatly explaining the balance sheet and the cash flows. Now, as a substitute tutor, for now, I'll be explaining furtherly of a cash flow statement. As a cash flow, I already mentioned you that there is an accounting standard on this. It's an IAS 7 statement of cash flows or the cash flow statements. The IFRS board has issued it. But in a US, you prepare an accounting standard according to ASC 230. So there are some differences. These are just a little bit differences. But I hope we're gonna work and we're gonna learn the differences very much. These are very helpful for us to work on. First of all, we understand that there are the financial statements. We look toward the backward that we have an income statement or statement of comprehensive income. Then we look toward the balance sheet. We look toward the cash flows. We look toward their interrelationships. We understand the elements as well. Now, if we look towards forwardly, it states that the statement of cash flows must be presented by all businesses for a profit and a non-profit, public and private. Now you see each company type has been mentioned here. That whether your organization or whether your company is profit, let me highlight it. Whether your company or a business is a profit making, then if your business is a non-profit, you are required to prepare a cash flow statement. Let me highlight all the keywords for you. Next, we have a balance sheet looking towards an income statement. We have public and private organizations or a business. Whenever the company presents either a balance sheet and an income statement or just an income statement. So you are required to prepare the statement of cash flows. It is an important statement. It states the statement of cash flows must be presented by all the business. Your organization should prepare a statement of cash flows. You need to keep in mind. You have all of these statements. Your organization's type. It says next. Thus, if a company presents income statement only and a no balance sheet for the prior periods, means you are presenting an income statement for current year and there's no balance sheet for the last year or a current year, then you must require to prepare each year cash flow statement. I hope you understand. Slowly, we're gonna move forwardly. You need to understand what it is explaining in this paragraph. It explains you are required to prepare the three major statements. First of all, you have an income statement. Next, you have a balance sheet. Third, you have a cash flows. You are required to prepare a cash flow as well for all of the organizations, all type of businesses. Next, if you present the company's income statement only, there is no balance sheet required. There is no balance sheet data for a current year or the previous years. You are then required to prepare cash flows as well. You are required to present income statement as well as cash flows. It states furtherly The primary purpose of a statement of cash flows is to provide information regarding cash receipts and cash payments. I hope Mr. Usman has explained you very well about cash flow statement as well, but as an tutor, I am explaining you the thing from your textbook. Theory understanding is very importantly. You understand the concept, but theory is also an important. It carries an equal weightage in your preparations. You need to understand that your company should prepare cash flows, all right. It is an essential part of your financial statements, all right. Next, you present your cash flows to all of the businesses, all right. What is the purpose of cash flow statement? The purpose of cash flow statement is to record or is to provide an information about your payments, about your receipts, cash inwards and cash outward, cash debiting, cash crediting, made by company during a period, means during your time period. You have a cash, include cash on hand, demand deposits account, and other kinds of account that a company make deposits to and withdraws from at any time without prior notice or penalty. So it explains the different types of cash. You have a cash on hand. Let me highlight it. You have a cash on hand. Then you explain furtherly. Look towards the demand deposit accounts. All of these are just the components of a cash. Then, furtherly, you look towards all the accounts in which company can deposit or company can withdraw at a certain time in their hour of need. This is called your cash. It furtherly includes your cash balances, cash and cash equivalents, your restricted cash and restricted cash and cash equivalents. These are just a kind of cash which you are required to show, which you are required to prepare in your financials. All charges and credits to those accounts are cash receipts or the payments for the purpose of statement of cash flow. Yes, for the purpose of statement of cash flows, you're gonna add or you're gonna reflect all the balances from a cash receipts on the balances of a payment charge. It says note, very importantly, the term cash is used in a context of statement of cash flows, refers to the total of a cash, cash equivalent, restricted cash equivalent. The four classifications are combined for the purpose of reporting activities in a statement of cash. So these are all the four kinds as it has been mentioned. This is the classification of a cash for a reporting purpose. And you need to present, you need to add the reporting purposes on your cash flow statement. When used information in other financial statement and related disclosures, just wait for a second. You have related disclosures. Related disclosures means you're working, your supporting schedules, your notes to financial statement, your ledgers, your T accounts, your trial balance, your workings, journal entries. The statement of cash flows help investors. So who are the users of financials? You help for the investors, creditors, and others to assess the factors. These are the primary users of a cash flow statement. Thus, there are multiple users, but now you need to see for anything. You need to see these factors are important. Company's ability to generate positive future net cash flows, all right. Then the company's ability to meet its obligations, pay dividends, and its need for external financing. This is a part of your financing activities that you pay off your long-term loans. You have enough cash to pay off dividends. You have enough cash to pay some extra finances to your users. First of all, your company should prepare cash flow statement that is very helpful for the lenders, creditors, receivables, for your investors, as well as some users of other financial statements such as government, your regulatory body in America, in a Canada, or in a Pakistan, etc. Then you meet or you prepare the cash flow statement as its importance. For as being explained below, you need to see the differences between your net incomes and associated cash flows. Net income is a part of your income statement. Net associated cash flows is being a part of your all the cash activities, operating, investing, and financing. Mr. Usman has already explained you about operating, investing, and financing, but yet we are understanding some further deepness of a cash flows. The fourth factor, effect on a company's financials position of a cash and non-cash investing financing. As it states earlier that you all clubs your investing activities, you club your financing and your operations to get a company's financial position, cash balance, current asset. It states what is a classification within the statement of cash flows. You got to see the three major categories or classification. It explains the statement of a cash flows present all of receipts, payments of a cash of a company during the period. For the purpose of presentation usefulness, the cash activities are broken into three categories. We already know that there are three categories, and very importantly, these are being explained as operating activities. First of all, you look towards investing activities, you look towards financing activities. Let us see some benefits and some limitations of a cash flows. I hope you are learning effectively for your September October attempt, and good luck for your exam. Wishes from Up Finance Consultancy. We are helpful for you. There are some benefits and there are some limitations. Let me go back to my Excel file and I'll be sharing you that thing. Let us see furtherly what a format your ASC 230 explains you. How you prepare the cash flow statement. Let us look that and then moving forwardly. So here at front, you have a name of a company. You prepare a statement of cash flows. You mention that you have a year end for which year you are preparing your cash flow statement. I already told you at the beginning that your cash flow statement is being prepared for only a year. First of all, you mention your cash flow from operating activities, then you show off your investing activities, later on moving towards your financing activities. If you see towards all of these, then you get to see net increase and cash equivalents and restricted cash during the year. So this is during the year movement. You got to prepare a T account, and after that T account, all the debits and the credits is called net increase or decrease in cash and cash. If there is a decrease, you subtract. If there is an increase, you add on your cash balance. Then your last year closing balance becomes the beginning balance of a year. Then current year balance appears. It says supplement schedules for non-cash investing and non-cash financing. You prepare some sporting schedules as well. Yes, those sporting schedules are very important. It says when the indirect method is used to prepare the cash flows from operating activities section of a statement of cash flows, the supplemental schedule showing the amount of cash paid for interest and amount of cash paid for income taxes must also be disclosed. This point is relevant to your IFRS standard as well. It relates towards your IS 7 workings. It explains you IS 7. Under indirect method, you are required to show all of your workings for investing activities, for financing activities, for debts working, your interest workings, your depreciation schedule, all of this working can be showed, and these are very importantly for your cash flows As it has been mentioned at the below, that you are required to show statement of cash flows disclosures as well with other disclosures. Yes, you are required to prepare the disclosures. If I move forwardly and I see that your cash inflows and outflows you can present separately, your foreign currencies, we're gonna move each and every item side by side, slowly, slowly. Let us move forwardly, please. Cash flows in and outflows for presentation of separately. So you present each line item separately, whether you invest, whether you got purchase it, whether you sell it, whether you got disposal proceeds, you're gonna show it separately. You have a cash flows from operating activity. This is much complex and it should be reported differently. Yes, there are the two methods of cash flow from operating activity being to be presented. First one is direct method and second one is indirect method. The most preferable method is called indirect method. Here you have an example. It states cash used for the purpose of purchase of fixed asset. It means yes, we are being reported cash outflows. We should report as a separate line item for a cash received from the sale of fixed asset. So you should report or you should show separately your purchases. You should show separately your expenses. Means your inflow, your incomes that has been inflowed, your cash debits, although both are reported in cash flow from investing activities. Just wait for a second. I'll show you in the next workings. However, if a question asks for the net cash flows, just wait for a second. It says, however, if a question asks for the net cash flows from a particular activity of a particular category, the inflows and outflow for that activity must be netted together. Outflows are greater than inflows. The net amount would be negative. Yes, if we get a negative balance, this negative balance indicates that we are heavily investing in our cash flows. We are heavily investing in property management. We are heavily investing in our land. We are heavily investing in some other investments, but we are not selling our previous things to get a cash balance, to get a balancing cash. You need to understand these things. Let me insert a new thing here for a shortcut key, Alt, and then I need to present W for the view and then VG to remove the grid lines. Just for a second, cash flows statement. Then I need to present, just here I'm adding a company of my name. Then cash flow statement. I represents the cash flow for the year ended 20x9 or whatever I need to see. Then I prepare my cash flow statement starting from cash flows from operating activities, moving towards the net incomes. Then I add back my non-cash expenses. Moving downwards, I get towards my changes in working capital. As your working capital being the part of your current assets and current liabilities, I shall mention here as well. Current assets, current liabilities. Then you got a cash flow from operations. You deduct your income taxes. You get cash flow from operating activities. F2 key. Here at the below, after that operating cash flows, you got to see cash flow from investing activities. You add on your purchases. By the way, I explain you add on. You not need to add that balance as it's a cash outflow. You would be subtracting that balance. Purchase on non-current asset, disposal proceeds, or you can type sale of NCA, then you can type sale of land, get a positive balance, and here at the end you get cash flow from investing activities. See, each line item should be presented separately. That this concept has been mentioned there, and this I explain you in an Excel. You should present each line item separately. For your working capital, all of this working should be presented separately. Your account, current assets, your current liabilities, then you got changes in working capital. You add or you subtract your non-cash expenses, gains and losses, whatever its nature, then you add back in net incomes, you get a cash flow from operating. Similar way, you got to see the financing activities. Each line item should be present separately, should not jumble up to the previous information to communicate wrong information. Cash flow in foreign currencies. It explains for a cash flow in foreign currencies, the exchange rate that was in effect at the time of cash flows should be used. However, if average exchange rate gets a similar result, the average may be used. So your standard is being referring you that you can use an average rate. Average rate is very important and it helps out to get a weighted average amount. See, you got a cash in a foreign currency at a time 23rd December. You are exchanging at the time of you can say 14 January or 15 January. What will be foreign currency exchange rate? That's your question. So you are being referred in your standard that you gonna be use exchange rate at the time of a cash flow being used. You are using cash flows at a December time. So at that time exchange rate would be used. It says classification of items within a statement of cash flows. As earlier been stated, you have an operating activities, investing and financing activities. All of these uses and all of these increases, it must be equal to the net increase or decrease in cash and cash equivalent. Net increase or decrease in cash is also reported in statement of cash flows. You have some operating activities explanation as well. So you got to see cash received from customers direct method. Cash receipts, interest and dividend from returns of loan, other debts, instrument, equity, securities. You can use for an direct method as well. All other cash receipts for a transactions you defining investing and financing activities. Cash paid to supplier, its main purpose and it's being used for a direct method. You use a cash for other suppliers and employees. You use a cash for the government taxes and other fees. So you should see the nature of your expense. It has been explaining government for the taxes and other fees. If other fees include a little amount of taxes, that must be reported separately. Cash interest paid on bonds and other debts such as loan, finance, leases, and mortgage, net of any amount capitalized, including payments for settlement of interest or zero coupon debts. Yes, this should be classified as an operating activities. So there has been change. There has been different classification as your IAS 7 refers and as your ASC accounting standard codification. Let me highlight it for you. ASC 230, it explains that this is a list of an items which should be reported in your operating activities. Very interestingly, you're going to report your interest, you're going to report your taxes, you're going to report other taxes or other fees of a government, you're going to report your cash payment to suppliers, cash payment to supplier for your manufacturing materials, cash payment to supplier or your notes payable, etc. All of these are the line items for your operating activities. The format which I showed you earlier, that was being discussed by your IS7. So you can see that there is some limitations, there is some similarities, but there are very much differences as well. You need to understand that difference. If you're a master of your accounting standards, your IFRS standards, then it is very easy to understand your accounting US GAAP accounting as well. Both understanding is very important. Sometimes you're going to work on your US accounting books and sometimes you're going to work on your IFRS books. You need to understand these things. It says furtherly, you pay a cash for a settlement of an asset retirement. All right. Your employee benefits. You pay cash to acquire some contingent consideration, some contingent liabilities. They are not made soon after the business combination. So they are giving us limitation that when there is a business combination, when there is a consolidation, when there is a goodwill working, you cannot use that cash. Your contingent liability is not that apart. You need to understand that as well. Other cash receipts and payment that do not stem from a transaction defined as inventory. So you need to see that the classification of cash transactions which are not being the part of your financing as well as your investing. Cash receipts and cash payment resulting from purchase and sale of securities are classified as trading security, debts and equity are classified as statement of cash flows on the nature and purpose for which securities were acquired. Usually cash payments and cash received from purchase and sale of trade securities are being the part of your operating activity. See, it's make a difference. Your ASC 230 makes a difference that when you pay a cash or when you receive a cash on your purchase and sale of trade securities by banks, by brokers, by dealers, or some other ways, but its classification refers to the securities. You are referring your classification as a security, then that cash balance is being reflected in your operating activities. It has been stated the value as well. It has stated the value as well are carried at fair value or the lower of amortization cost basis or the fair. So yes, you have a fair value as well, or you have another thing that lower of amortized cost or fair value, whatever the lower is, that would be an amount using for a classification of operating activity. The practice to your MCQs, the practice to your essay questions would be very helpful for understanding furtherly cash flow statements. This workshop specifically considers making your concepts widely, refreshing your mind, getting you a hands-on grip on your study. It says further, in addition, certain cash flows related to leases are classified within operating activities according to your standard. Leases detail has been followed. All right. So leases have been separately mentioned as a lessee, then lessor, and then we're gonna move forwardly toward the cash flow from investing activities. So if we are moving toward the leases, first of all, we're going to classify leases as a finance lease. And in a finance lease, towards looking a lessee proportion, lessee classification, it states lessee classify payments of interest on finance lease according to requirements of interest, the statement of cash flow, generally within operating activities. You need to understand earlier that there was a list available that here it has been explained that whether you pay off loans, finance lease, your interest payments on bonds, your interest payments on other debts, your interest payments on your zero coupon bonds, zero coupon debt instruments that are being the part of your operating activities. Following specific items classified as an operating activities. You need to understand this. You are paying an interest, and then interest is being a part of a finance lease. That should be a part of your operating activities. Then do not remain quiet. It says furtherly, payments made that reduces the lease liability low or increase, that should be the part of your financing activity. We already know that when we pay for a lease, when we pay for any equity portion, or when we pay some other debts instead of interest payment, that is being the part of your financing activities. This is similar point towards your IS 7. Operating leases. Lessee classify all cash payments arising from operating leases within operating activities as cash outflow from operating activities on SCF except to the extent that these payments. Alright. If it is a lessee, first point, it is a lessee, alright. Which lease is type? Operating lease. It says you have a cash payment, alright, we understand that cash payment should be the part of your operating activities. There is an exceptional to this rule. Let me highlight my exceptional. It says there is an exceptional that any payment of an operating leases which represent a cost to bring another asset to the condition and location necessary for uses, intended uses, which should be classified as operating investing lease. So, for example, a lessee has purchased or lessee has leased an asset for its business, for its core operation uses, and that asset has been available to the workable condition and location according to IS 16 or according to your ASC board standards, then that payment should be classified as an investing activities. While all other payments of operating lease would be classified as an operating activities. There is a difference. You need to understand this difference. There has been quite, from a lesser point of view, that if there is an operating lease, your all lessors are required, all lessors classify cash receipts from operating activities within, from operating leases within operating activities. All right. So there is no jumble up in a lesser point of view. Then we come forwardly toward the cash flow from investing activities. Before moving up, we have a simple type remaining, sales type and direct financing lease. Lessors that are not financial institutions, normally dealers or manufacturers, classify the full amount of cash received from a sale type and direct financing lease, both interest and the principal within operating activities. Now, first of all, you need to see whether you are lesser. Yes, we are lesser. Next, which type of lease we are incorporating, whether that lease is a sale type or whether that lease is a direct financing lease. By the way, sale type and direct financing lease are same. All right. Third thing, you need to see operating lease. Now, you are lesser, you have choose operating lease, no need to worry. All your cash receipts from operating leases is a part of your operating activities. Greatly. Next, if you have a lease, all right, you are a lessor, you are direct financing leasing or sales type. Next thing, you are financial institution or not. If you are financial institution, Then your interest portion comes within operating activities. Here you can see if you are financial institution, then your cash receipts as an interest portion, whatever that interest portion is from a total payment, whether it's a $10 or it's a $20, it's $100 or $1,000, that should be the part of your operating activities. And if you are not a financial institution, no need to worry. All of your interest payments, all of your principal receipts, means your payments. By the way, I'm using receipts instead of payments. That is a wrong thing, but I hope you understand from a book, and that has been available in a front. Your financing leases are type of a direct financing or a sales type, and if you are not a financial institution, then your operating activities would include interest received and principal amount received from lessee. This is the difference. If you received furtherly the principal portion of a financial institution, that's a part of your investing activities. I hope you understand very well about this. I worked for my full dedication to explain you this. I hope you're gonna learn very much from this session, and I need a positive feedback. Now we have a cash flow from investing activities. You again have a list of instruments available. I made a list for previously in Excel as well, but now you can see a list for financing activities also available. You have two methods already been explained to you. There are some further things to we need to understand, and that will be explained literally. I hope it. So there are individual accounts adjustments, some of the cash flows, account payables, inventory, some rules for your increase and decrease of working capital portion, which we're gonna see laterly. Let me go up towards my just looking toward cash flow from financing activities. It says financing activities are the activities a company undertake to raise a capital. Yes, you finance your organization, you finance your business through capital or through debts. There are some different types. You repay the debt at a time, you buy back your shares. Here is a list of activities that has been available. You get a proceed from issuance of stocks, you get a proceed from issuing bonds, mortgage, nor notes, and other short-term or long-term borrowings. You got a payments of cash dividends or some distribution to the owners. Note that dividends paid are financing activity, but dividend received are an operating activity. If you have some investments, then that is a part of your operating activities. But if you are being paying a dividend, then it's being a part of your financing activities. Furtherly, it says payment to reacquire company's equity instruments means you buy back your shares, you buy back treasury stock purchases, you buy back some other things. Principal repayments made to creditors, payments for debts issued, costs, payments for debt prepayments or debt cost, are lessee classification, repayments of principal portion. I already explained you this point very deeply that if you are lessee and you classify your principal amount of a lease payment of a finance lease, then it's being a part of your financing activities. In a books of lessee, it is not in a books of lesser. You need to understand that. Already your interest portion is being mentioned into the operating activities. Here up you got a list of that as well. If I got to see our list of investing activities that has been explained furtherly, that cash flow from our investing activities. Investing activities are the activities that company undertakes to generate future profits from investments. Investing activities including making, collecting loans, etc., your deposits of debts, your deposit of equity instruments, property management purchases, other asset purchases, other than the items that are part of inventory. Yes, remember that your inventory is a working capital part, it's the current assets. You have receipts from a collection, yes, you have a receipt of a sale of a loan made to the company, yeah, debt instrument for the company repayment, your transfer, trade receivables, etc. You got a receipt from sale of equity instruments. So cash inflows and some there are cash outflows. Cash outflow means you purchase your equity instruments of other companies. You purchase equity instruments of third company of a subsidiary of any business combination part that should be shown in your investing activities. You purchases, you got a purchasement or you got a payment of your land purchases that should be shown here. It says payment to acquire property management including interest capitalized as a part of those assets, while it explaining that interest capitalized, this means that your borrowing cost. In an IFRS there is a standard IAS 23 borrowing cost that explains about this. Payments made by an acquirer to settle contingent consideration liability that may be paid after business combination. All right, for financial institution of a lesser principal amount of lease payments received from lessee on a sales type and direct lease. All of this has been explained earlier in a detail, in a depth. We tried our best to explain you the financials. If you have any question, you have a WhatsApp group available, you have my question chat available, you have your instructor, Mr. Sman, as well for questioning. I hope this standard working, your understanding that was very effectively working for you, and good luck for your papers. Thank you very much.